On this episode of Full Signal, I sat down with Ryan Detrick of Carson Group. He is one of the most bullish and optimistic strategists on Wall Street, and he explained why he's been so bullish this year and why he's been so correct, why recession signals have not come to fruition, and what he's expecting through the end of the year. I hope you enjoyed this conversation. Ryan Detrick, I really appreciate you coming. I know you have been super bullish, super optimistic all year, and you have pushed back on pretty much everyone else that's been less optimistic than you. Can you walk us through what's kept you optimistic and some of the data that you're watching these days?
Yeah, Phil, first of all, thanks for having me back. I heard, not back, it's nice to see you again is what I meant to say. I heard I'm the second guest, so appreciate that, and congrats on this new podcast medium to discuss what's going on out there. So, yeah, at our team, Carson Group, I work with Sonu Varghese, Sonu, for 3 years. We've been saying along the same lines as it's not as bad as they keep telling you. And markets are all about expectations, right? It's not about really good news or bad news. It's better or worse news. And we came into this year, we were, again, overweight equities. We said stock market gained between 12 and 15%. By the end of the year. And those are targets. And believe me, I'm a strategist. I kind of hate giving targets. I just like to say I'm overweight or underweight because I might change my mind. We're allowed to change our minds. Sometimes people just say, oh, you can't change your mind. But we had that bullish target. Obviously, when the S&P was down 15% for the year, April 8th, down nearly 20%, it was uncomfortable to say, wow, maybe it's not as bad as maybe things are, not the end of the world like they're telling us on TV. Fortunately, we have come back. And again, we look at the world a couple different ways, but maybe get specifically to your question, it's shocking to me. The time we're doing this, S&P's less than 2% from all-time high. The number of people that just doubt it, we hear about, you and I probably talk about these things, bubbles, K-shaped economy, the Fed, inflation, all the worries, and they're valid worries and concerns. But when you look at something like the AAII sentiment poll, right? This year, the bears have averaged 11 percentage points more than the bulls. So there's been more bears than bulls, okay, on average this year. Yet the stock market's up 17% time we're doing this. I found only 3 other years in history we saw a period like that. They all were like negative years and bear markets. I mean, 2008, you've got like as many bears now as you did in 2008. So that's just one sentiment poll, and I wouldn't get too worked up over just one sentiment poll. But I think it just is shocking to us, again, how quickly people get worried, they turn bearish, and then we avoid the asteroid one more time, and it keeps going. There's a lot more to it. I'm looking forward to talking with you about it, but I think at the end of the day, it's just those expectations are still awfully low, in our opinion, for a strong bull market with a pretty decent economy.
There's definitely a lot more bears than bulls as far as the people I'm speaking to. And I think that's surprising based on what you're saying. Something I've looked at in the last year, we've seen a much broader rotation in the market, right? It used to be much more tech heavy, still is tech heavy, but we're seeing the small caps, mid caps sort of catch up to that. How much does that play into this strength of the bull market?
A lot. Now, at the start of this year, it's funny, if everybody's thinking alike, somebody isn't thinking. General Patton, I use that all the time. I love that one. When President Trump won, I guess like a year ago right now, everybody told us the dollar had one way to go. That was up. Now, our friends at The Economist, who maybe they're a little skeptical when you look at some of the recent Economist covers the last couple of years, they had a image of like $100 bills rolled up shooting into outer space with like stardust sprinkles behind them. That was in November of last year. Okay, that's not normally how The Economist looks at things. And I said on our team, I said, wouldn't it be something if the dollar went lower this year? Because again, another one I love to use, history doesn't repeat itself, but it often rhymes. When Trump won in 2016, dollar went up, and then 2017, dollar went down a lot. And we were open to the idea that maybe and again, this sounds obvious now, well, the dollar's having a terrible year. Trust me. In late January, when Sonu and I on our podcast, Facts versus Feelings, we were talking about the dollar may be peaking. People hated that because it wasn't, and no one else was saying it. So we actually, we managed almost $7 billion on the Carson Investor Research team, Sonu, myself, a couple other people. And we've been overweight the U.S. When I met you, several years ago, we liked the U.S. a lot, right? 23 and 24. But earlier this year, Sonu looked at what was going on in Europe, specifically Germany, doing a lot of fiscal policy, a lot of spending, a lot of things with their deficit that they hadn't done in a while, like ever, really. And he said, something's going on here. And I said, wouldn't it be something the dollar goes down and Europe actually starts to do some things to stimulate growth? well, maybe we should have some developed international. That's exactly what we did. I'd call it February or early March. We added a decent amount of developed international. So Carson Group is an RIA. We're in, I think, I should know, but I mean, we're growing like crazy. I think we're in about 43 or 44 states because every day we're adding some more. We just cracked $50 billion. I would go on a limb and say, for our RIAs our size, we have probably more developed international than just about anybody else. Yes, we have a lot of U.S. exposure, but we have a good deal of developed international. And I think the key thing is, yes, we've got a lot of participation to this rally, but it's around the globe. There are things around the globe going up. I mean, the time we're doing this, like virtually every country is hitting all-time highs or 52-week highs. And I know we sold off a little bit the last couple of days. Let's say last month on a monthly closing basis, like just about every stock market out there closed at a 52-week high or an all-time high. The big question, of course, is, well, in 2017, we saw that also, where the rest of the globe did well. U.S. did well, but the rest of the globe did well. Then for most years other than that, it's like, you better be in U.S., you better be in big, large cap tech, or you're, underperforming your benchmarks and not doing so well. We do think, Phil, that this global expansion with a lot of other countries doing well is here to stay for a while. Now, what's a while? I don't know. 2-3 years, maybe? Yeah. Maybe 5 years? Yeah. I mean, I think when you look at Europe specifically, like just this year, Europe broke out of levels that they were trading at in 2007. Think about that. I mean, literally for, well, if my math is right, 17, 18 years, the European stock markets on the whole went nowhere. Massive breakout this year. We don't think that's about to end. Do we still like the U.S.? Absolutely. But I think from a diversified portfolio point of view, you want to be overweight equities. Last comment here, you think about a 60-40 portfolio. Now, we manage a lot of portfolios and have a lot of goals with our portfolios. We're about 71% equities, okay, in a 60-40 portfolio. So that's overweight equities. We have a good amount of that in developed international and a little bit of emerging markets as well, along with U.S. So be overweight equities, but have more of a diversified bucket in that equities you're investing in is how we see the world and continue to see it.
I think overweight equities has been totally the right call this year, overwhelmingly. And we've
maybe overweight gold.
Overweight gold's been excellent.
Yeah.
What do you think it is that's stopping people from participating in this bull market? Or not participating, but people keep doubting it. And, I've seen multiple people come out and say, this is the most hated bull market. What do you make of that?
With Pomp and Tom Lee, was it this room right here? They did the video like a week or two ago. Yeah. So Tom's been all over that. A shout out to both of them, Pomp and Tom Lee. It is true. I think this is a hated bull market, and I can't give one reason why. I think politics do play some into it. I think the fact a lot of people have missed this rally. I look back in April. People know what I do. The number of people that I heard from when the market was crashing and Trump was going to ruin everything and the bear market was here and tariffs are going to cause all this inflation and set us back and all the stuff that we were hearing every day. The number of people that I heard from, hadn't heard from for 2 decades that were telling me, I'm getting out of everything. What's going on? This is crazy. I'm looking around thinking, wow, if that person, no offense to them, doesn't really follow the stock market, just follows the headlines, is telling me how bad it is, I bet a lot of this stuff is priced in. And that's kind of where what we saw. And the truth, again, a lot of people sold. I mean, it's unfortunate. I get to travel the country, work with some of the best financial advisors, period, get to meet their clients. Every time you do a client event, you got 150 people out there. There's always somebody that comes up afterward and says, "Here's the deal. I sold in 2000 after the crash, at the crash, or 2002 maybe the crash at the bottom. I sold at the bottom of great financial crisis. I sold at the bottom of COVID. What do I do now?" I don't have the answer there, but I mean that is the honest truth. And you see the numbers. Approximately 82% of fund managers are underperforming their benchmark this year. They might tell you they're bullish. But if 82% are underperforming their benchmark, are they really that bullish? Are they really that much overweight equities? No, because I think just about everybody under the sun in April panicked, said there's a recession, and got out. And believe me, we were worried, yes, about the same headlines, the same headline risk. But the truth, again, is if you weren't overweight equities going into it and hung tough, you're behind your benchmark. And I think the truth is a lot of people are angry about that as well. And one more thing on this. I mean, I'm old guy now. I'm not as old. I'm a Bengals fan, not as old as Joe Flacco. But you see what Joe Flacco is doing. I know they're losing. I know the Bengals are losing, but the guy's throwing for like 400 yards and 3-4 touchdowns. So just because you're old doesn't mean you don't know something here. I'm going to go with that. In 2013, this is when social media, when did you start in business? What were you doing in 2013? Like second grade probably or something?
2013, I was a young kid.
Yeah, youngster. So that's how old I am. So I came in this great city of New York, running around doing my thing. And Twitter was around then, but it wasn't that popular. It was what it was. Anyway. the market was breaking out of a 13-year range from 2000, a major peak, then a crash, and then 2007, another crash, 2013 broke out. And I was one of the few people out there running around saying, hey, we just had a secular bear. We're about to start a secular bull because we're breaking out after 13 years of going nowhere. The aughts were the worst decade ever for investors, worst in the 30s. I mean, think about that for a second. And to think how hated that was. I mean, it was, I remember going on TV back in the day, 13, 14, 15, and CNBC would say, hey, you still bullish? I'd say, yes. They'd say, good, because we can't find another bull. It'd be like a bear bull debate. I'd go on TV all the time back then to talk about why we were entering a new structural bull market, a new secular bull market. History doesn't repeat itself. It often rhymes. Mark Twain. These secular bull markets last a couple decades. Now, I don't know if this one will, okay? You go back in history, right? The stock market broke out to new highs in 1950, went up for 18 years in 1968, broke out to new highs in 1980, went to 2000, and we broke out in 2013. We're 12 years into this one. I have no idea if it's about to end or not. I don't think so. I just think these secular bull markets go a lot longer. I mean, every year's going to be up. 2011 stocks were flat. 2015 stocks were down. 2018 stocks were down. I mean, 2020 you had a 34% bear market in 6 weeks. You still gained 16% on the year. There's one more thing on that. Maybe then I can just talk all day. I want you to ask me something. What's so crazy about this year? A lot of things. Down 15% for the year on April 8th. We're up 16%, give or take, time you and I are doing this. Let's assume that we finish up double digits this year, which I think is a pretty good bet, and we're still bullish the rest of this year, so we think probably a little more juice to go. Only 3 times in history, Phil, has the S&P been down 15% for the year at some point during the year and finished in double digits. Okay, so you're talking a slingshot, right? I call it the slingshot. 82, 2009, 2020. The next year, after all those times, every year was up double digits, 19% on average. I know it's a small sample size. I mean, if there were more examples, I'd use them. But I think what we've seen this year, it really was a true freakout moment. That near bear market, whatever you want to call it, was kind of necessary because everyone had done kind of well for a couple of years. We needed to shake the tree. What did we know? Well, we know the first half of a post-election year is usually pretty volatile. We know the first quarter after a 20% gain is usually really weak. We know the first quarter of the last 20 years has been pretty weak. All these things led to us saying, be open to the idea of a 12 to 15% market correction. Why? Because we hadn't had one for 3 years. I mean, we were due for something. No, we didn't think it'd be 20%. We didn't think it'd be what it was after Liberation Day when President Trump held up that piece of paper and we all kind of zoomed in and said, oh my goodness, effective tariff rates up there? That's why we all sold off. But now here we are. And Sonu does amazing work on this stuff way above my pay grade. He's like, the effective tariff rate's like 12, 13% right now. At the start of the year, that's kind of where we thought it would be. It came at 26%. Trump's throwing out these crazy numbers. Now we're back to kind of where it was. And markets are all about those expectations. And now the trade war with China, it seems like, this is wood, knock on wood here. It seems like that's been kind of punted out of the way. You've got earnings have been strong. There's lots of still the Fed. We can get into the Fed more, but I mean, the Fed is still a bullish driver in our opinion. And I'll just be quiet and let you ask me something. But there's still reasons to think this bull market has time because secular bull markets last a lot longer than you think. And I don't think this one's over after 13 years. I think it's got more juice left.
Well, I know this year we're having a better post-election year than usual. Yeah. And we're also, the reflexivity we saw in April was way more than usual as well. The bounce back was way more than a typical bear bounce, right? I think a lot of the fears that people have right now is, of course, about the .com comparisons. And I know you're the history buff here. What do you make of the AI boom today versus how it compares to the late 90s, early 2000s, whether it's a warranted comparison or I honestly think it's pretty moot because I think the companies today are so ridiculously profitable and their balance sheets are so big. I don't think the comparisons are that valid, but what do you think?
No, well said there. I will say this. If you look at, I'll leave that in a second, about post-election years and stuff we were writing about, talking about start of the year. If you go back the last 40 years, so that's the last 10 4-year presidential cycles. The post-election year is by far the strongest, up 18% on average, higher 9 of the last 10 times. So you could argue post-election year has actually been pretty strong lately, and that's kind of where we've played out so far. Now, a little more story about me. So in 1999, I went to Xavier University in Cincinnati, Ohio. I didn't know what I wanted to do. I thought I'd be an accountant. I always like numbers, right? I thought I'd be an accountant. I realized real fast, I don't care about that. I don't care if those numbers match up. I mean, they matter. Publicly traded companies, they matter. But for me, that wasn't what excited me. Now, for those who might have read your history books, literally like I mean, right now through March, so November through March, the NASDAQ like doubled or something. It was the craziest darn thing. I mean, it went crazy. Late 99 to 2000. I got the bug, right? I got the bug. Now, I remember skipping like theology class. I was like, why am I going to go to that? I can go buy some penny stock that some website you had to refresh in the library, and it was super slow, and then you go to your account and buy it. I mean, it was crazy times. And I don't feel like people doing that at all. Now, I know there's some of it. In 21, I thought we were getting vibes of that. In 2021, I thought there were some vibes of the .com where people getting money from the government. Nobody was working. Or if you were working, you're getting paid, but you really weren't working because you were gambling and you were doing this, you were doing that. I mean, Dave Portnoy, not a big fan of Dave. He's like, he looked out his window and saw a deer. He's like, deer, he bought the stock of deer and it went up. I mean, when you see stuff like that, you're like, okay, maybe we got to pay the piper. And then what happened? 2022, stock market down 25%. Bonds had their worst year since George Washington was the president. Gold was flat. I don't care what you invested in 2022. You didn't do very well, right? We had to pay the piper because how 21 was just crazy. Fast forward to right now, I'm in the camp where you are. Those big Mag 7 names make a lot more money, right? I'm probably going to butcher it. You wrote about it. What did Powell say? He's like, in the 90s, they were ideas, not companies. Yeah. Now, he knew that question was coming because, a month ago, he kind of hinted at there was maybe a bubble here. He knew that question was coming. I thought that was pretty good. Now, the truth is, you've got the 7 and you got the 493. Yes, the Mag 7 is pricey. Sony did some incredible work. If you look at 3 years off the October 2022 lows, NVIDIA was up 1,500%. NVIDIA's earnings up 1,425%. You look across the board, Tesla is the only one that was all multiple expansion. All the other ones, the other 6, were making a you-know-what amount of money, okay? So it's hard to say. And the other answer is, listen, we manage money. We're slightly overweight equities. We are overweight equities. Slightly overweight tech. You kind of have to be, I think, if you're bullish, because that's still an area we like. Are we wildly overweight? No. But if someone is uncomfortable with AI, overvalued, oh my goodness, here comes .com. Well, go back again and look at those odds I talked about. Emerging markets did really well. Gold did incredible. Small caps did really well. There's pockets of the market that did well. So, I call it chase the shiny object syndrome. You don't just invest in the hottest stock or the hottest sector the year before, because odds are it's not going to be the hottest the next year. It might, but eventually it's going to get there. So you need to stay diversified. I would say work with a financial advisor, maybe a Carson Group one. Got to give a little shout out there, to help you from yourself a lot of times. But we don't think this is a bubble. We don't think this is unjustified where we are. Maybe stretched. S&P is 13% above a 200-day moving average. A lot of those big ones are even further. Maybe we're due for a little hiccup. Maybe we're due for a little consolidation. But the reality is you tend to see a chase at the end of the year. When you're up 15% for the year going into November, like we are obviously this year, November and December, those 2 months have been higher 20 out of 21 times. The last 14 times you're up 10% or more going into November, November's been higher. I'm not making us make up the numbers. I just look at them, right? There is a chase in the end of the year. So it could be a little more juice. But as you head out into 2026, maybe lighten up on tech. It's okay. That's fine. I mean, look at what healthcare is doing. Healthcare is awesome. We like tech. We like industrials. We like communication services. And we actually add a little bit more utilities. Now, utilities are not your father's utility. There's a big AI component, but there's still a defensive nature to them. So I think, if you want to do like a barbelled approach, you can do some things like that. And that's how we see things, how we're investing. I have no clue what you asked me. I probably didn't even answer it, but hopefully some of that made sense.
It all made sense, and I agree with most of it. And I like that your analysis is always so data heavy. I want to pivot here to the K-shaped economy, right? And we've seen a few CEOs come out in their earnings calls. We saw Chipotle come out and say, hey, our young people and our lower income customers are not coming in as much. And we've also recently heard Delta Airlines CEO come out and say we're selling more premium airline seats than the basic economy seats. And then we also, one more data point for you, new vehicles now cost $50,000 for the first time ever. So the backdrop to all of that is that we're breaking records in all these asset prices. What's the story here?
Yeah, there's a lot of angles I can take this one. If you look at the economy, there are people clearly struggling. I mean, it's obvious, right? And again, who is it? Well, younger people or people who unfortunately have not invested in the stock market or had, owned a house the last decade or two. I mean, that's the honest truth. Now, the other honest truth is the stock market's very cold. The stock market doesn't care about some of these things we're talking about. It doesn't have feelings. I learned that a long, long time ago about the stock market does not care about our feelings. And investors, if you think they do, you're going to learn soon enough they don't. As a steward of assets, Sonu and my job is to look at the aggregate. The honest answer is the top 10%, they do consume about 50% of the economy. The top 10% still in pretty good shape. The top 30-40% is still in pretty good shape. I wish I had a better answer for you here, other than the fact that who is moving the economy is wealthier than they've ever been. Balance sheets, honest to goodness, household balance sheets. Yes, every quarter this data comes out from the Fed. Credit card debt's at an all-time high, 1.2 trillion, 1.24 trillion, 1.29 trillion. Every quarter goes up a little bit. But someone who's done some really cool charts on this, just look at disposable income, right? I mean, disposable income's up exponentially more. Net wealth is up exponentially more than credit card debt. So sure, credit card debt's high relative to whatever number you want, but on a relative apples to apples comparison, it's nowhere near as high as it was like in 2000. You think about what gets you into trouble, it's leverage. Oh, what's the quote? And I'm going to butcher it because we're live here. Charlie, who's Warren Buffett's right-hand man? Munger said something like leverage, women and whiskey have gotten more investors in trouble. I mean, something like that. You guys can Google it. It's something along those lines. Those three things that get you in trouble, especially you do all three at once. That sounds like a lot of trouble. But the truth is we had a ton of leverage on margin debt and different things in 2000. In 2007, it was different things with banks going like 40-1 leverage. I can't even do that anymore because different rules put in place. So we don't have nearly as much leverage in the system. We know corporate America's balance sheets are pretty solid. I mean, they're making a lot of money. Earnings season's been strong. You've been writing about it. And by the way, I love your newsletter. Read it every day. And you throw me in there sometimes. So thank you. It's great work. I always get like a little nugget. Well, not just one, multiple nuggets, but always at least one little, ooh, that's pretty good. I'm glad because I'm running around, flying around. Like I got people I like to read, and yours hands down.
Thanks, Ryan.
Right there, one of them. So now I'm done kissing you know what? Where was I? Where was I? I got sidetracked. It's been a long day.
Leverage.
Thank you. Thank you. So there's not nearly as much leverage in the system now as there was. Oh, household balance sheet. That's where it was. Sorry. Corporate America's balance sheets are truly in pretty good shape. Household balance sheets are honestly on the aggregate in good shape. The K-shaped economies are unfortunate. I don't have any answers, as to what to do other than from a purely markets point of view. There's still reason to be invested. Hopefully some lower income people, if they can find some income and find some extra money. I know that's harder said than done. I understand that totally. I've been laid off. I've been fired before. 10 years ago right now, I was unemployed, couldn't pay for Christmas presents. I know, I've been there. I understand that more than most people. Well, not more than most, but I understand that's what I meant to say. Sure. So the truth again is there's still some opportunities out there, but it is a difficult situation, but the economy from the aggregate still looks good.
So I hear what you're saying, and I have conversations with people. They can't get jobs, they can't afford certain restaurants anymore, things like that. But then when I talk to investors and asset allocators, they're having the time of their lives. So it's a very different and that's also generational as well. Older folks are doing better than younger folks.
That's true.
So when you have these conversations with your clients, how many of your clients are asking, hey, I'm worried about a bubble, let's pull out, versus your clients saying, I'm afraid of missing this rally, let's go all in?
Oh, well, I don't get that second one very often. I joke, I never get the question, wow, it's pretty good out there. Economy's pretty good. Stock market's up globally. Gold's up a ton. I know Bitcoin's come back a little bit, but still crypto's been up a lot the last couple of years. I never, ever get that question. Clients are still worried about the things you're talking about. Now, the real world things. And my daughter, Susanna's a senior right now. Actually, the time we're doing, what time is it? 4:00. Yeah. Like an hour and a half, she's going to have her senior year cheer awards. So I'm going to miss that. That's amazing. Too bad. Yeah. But I have a daughter going to college soon. And that's fine. She's got good grades. She'll go to college in 4 years and hopefully graduate. Okay. I'm worried about her getting a job because I've got friends a little older than me who are saying there aren't any jobs for kids getting out of college. Is it truly AI? I don't know. Maybe, some of it is. I don't know. Hopefully 4 years, I say hopefully 4 years is, or 5 years is a little different for her. But those are some real structural issues that are happening out there. And again, from the market's point of view, the market doesn't really care because productivity's high. And what are all these companies saying? What did Zuckerberg say? I'm going to paraphrase it, but I'm willing to go bankrupt over this whole thing. I'm going to spend a ton of money on AI and not lose this race to so-and-so, 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 because they're all really competitive people trying to win the AI race. So those are some real valid worries that we have. You mentioned cars at $50,000, new car. I mean, that's crazy. I don't know any other say than crazy. Do you fly a lot? Do you fly often?
Sometimes, not as much as I should.
So, well, that's all right. You ever get to Cincinnati, say hi, though.
I will.
The odds are I'm not there, though.
I know you travel a lot.
Probably better off seeing you somewhere else. What I'm getting at, though, there was a time in 21, 22 when every time I flew, they'd say on the loudspeaker, hey, the plane's full, $400, you want to take the next flight? I honestly, Phil, don't hear that anymore. Ever. I normally get upgraded, I fly a lot, so I'm kind of maybe the one in the front. But the back of the plane is struggling. And clearly, just from my anecdotal view of, I never hear them offering money because the plane's full. So that tells you right there what's going on, but the front of the plane's always full. So that's that K-shaped economy that I don't have the answer for, but it's just some things that we're seeing structurally that are clearly, you hate to say, this time is different. The 4 most dangerous words, Sir John Templeton, but there really are some things. You know, that chart that's out there, and maybe you can throw it up right now for showing that stock market going up here, but JOLTS going down here. Everybody's talking about the K-shaped economy. I mean, Sonu did some pretty good work on that, looking into that. It's like, well, there's no y-axis on there. It's not pure apples to apples, but still it gets people's opinions, or not opinions, it gets people's antennas up when you hear these things. And the real world example of kids are having trouble getting jobs out of college. Yeah. That's real world stuff that's impacting everybody.
Well, kids, not only that, but late 20s, early 30s. I know plenty of people that have been looking for jobs.
Those are
kids. Well, fair enough.
I just had a birthday. What am I, 40? I'm 47. Yeah, birthday last week.
I was a very young man.
I don't know. There you go, yeah.
So and I know this is against your thesis and against the data that you've been presenting. If I had to force you to make the bear case for why stocks and asset prices could be about to turn lower, where would you start?
Yeah, I mean, hopefully we can use the F word on this podcast. The Fed, right? The Fed. I mean, we are aware that historically, when the Fed is cutting interest rates without a recession, the market likes it. Even when the Fed cuts interest rates with inflation a little stubbornly high, the market likes it. We've got 3% inflation. When we look at inflation, we got that CPI print, 2 weeks ago? You ever got excited because shelter's starting to finally come down? But when you peel back that onion, there's still some issues, Phil. I mean, not shelter, wrong one. Services inflation is a little stubbornly high. Goods inflation, well, it's probably because of tariffs. But there are some issues with inflation. But what's the Fed saying? They're going to be cutting. And I know he came off a little bit hawkish last week. Not buying it. I think he had to say that because they don't have data. But the reality, who's going to be in charge of the Fed next May? I don't know. You don't know. Somebody out there might know. We have a guess. I mean, there's 5 names. But it's going to be someone dovish. So the Fed is going to continue to cut. We're toying with the idea of what to call our outlook. I'm not going to give it away. I'm not going to say we're going to call our outlook. I'll tell you when the recording's not on. But the truth is there's a lot of momentum to this market. And if the Fed starts cutting without a recession, like we think they are, that's positive, right? I looked, Phil, 21 times the Fed cut with the stock market near an all-time high. A year later, stock market, you might have shared this data, so thank you, higher 21 times. I mean, that's just one data piece, but it's like, there's that don't fight the Fed. So you have a Fed that's going to be dovish. You have a Fed that's going to be cutting. Then you wonder, we're up 20% 2 years in a row. I think we're up 16, 17% time you and I are doing this. We're on record. We think we're probably going to be up 20 this year. It's not all that far away, honestly. We think we'll get a little bit of rally. It'd be 3 years in a row up 20. Then the Fed's really going to start juicing things. Okay, that might be good until it's not. So we're not there yet. But what are we doing about it? We manage money. If we're wrong, what are we doing? Well, we, Carson Group, added about 3% to our tactical models of gold back in March of 23. That was when the regional bank crisis happened. We were bullish back then. That's probably when I first met you. We were still bullish back then. We said, what if we're wrong? Well, gold might do okay. I never looked at gold like gold versus stocks. I always looked at it gold versus bonds, that 40%, that other stuff. Well, thank God we did that because gold's obviously trounced bonds and it's trounced everything else. We have some gold. We have some managed futures. We have that international exposure. Again, look at the aughts, what happened. Well, EM did amazing. Europe did pretty good. The U.S. did terrible, right? Sometimes those cycles last a while. I still like the U.S., as I've said, but we've got that exposure there. I mentioned we just added some utilities. We're overweight utilities. I mean, now again, it's not your father's utilities. So there are some things we're doing that if we're wrong, I like to think the market will give us warnings, though. I'm a technical guy at heart. I have a CMT, Chartered Market Technician. We hung out a couple months ago at the CMT event that Jay Woods and the team and the guys all put together. Where were we? Down on, what's that called? What's that street called?
We're in Vidai, Stone Street?
Stone Street. That's it. Yeah, we're at Stone Street. That was a good time. So I get on a tangent. I forget what I was talking about. Oh, here it is. I like to look at, market breadth, like advanced decline lines, cumulative basis, how many stocks going up versus down. Just a week ago, we're hitting new highs on those, okay? you've got highs on advanced decline lines. I do think you do have a lot of participation. You look around the globe. J.C. Brett's friend of both of ours. I mean, he's talking about all the countries hitting new highs. It's hard to say Brett is bad when you're seeing new highs across the board. I mean, South Africa, their stock market's up a ton. Yeah, gold's helping that, sure. But I mean, like everything's up. Everything's up. So there is participation. But the worry I think that people have is it up too much? Well, you can change your portfolio around a little bit. And I think we'll have warnings. We'll have those advanced decline lines warning us, and credit spreads. I always said the smartest people in the room are the credit markets, I think. Back in April when the market was collapsing and everybody I knew from 25 years ago in high school was telling me how bad it was. I remember hearing that. I looked at the credit market. Junk bonds are up on the year back in April. I'm like, wait a minute. Why are junk bonds up on the year? Now, they were down. I mean, they were down from where they were, but why are junk bonds up? If everybody on TV is telling me how bad it is, and all these people that don't really follow the stock market tell me how bad it is, maybe junk bonds know something. Maybe high yield bonds know something. And that sure happened. And you look at high yield spreads right now, there's still not a lot of stress in the credit markets at all. And I think you're going to see stress in the credit markets, breakdowns of advanced decline lines, and some other stats and stuff that I'll probably talk about. But those are two things I follow that for 3 years, they said things are okay. And I still think they're in that camp.
Well, Ryan, I asked you to lay out the bear case, and it still sounded bullish somehow. However,
I guess about a put a bow on it. The Fed hypes it up too. The Fed gets things too excited. The Fed keeps cutting rates when maybe they shouldn't, when inflation's a little bit higher, and that still rallies the market. But then we have even a bigger size correction, say in 2027. Not our prediction, not saying it, but that's the one thing that gets me is if the Fed just keeps cutting when maybe they shouldn't be, because that's what that's what they're almost ordered to do. That I can say that out loud. Yeah.
Mm-hmm. I hear you. So the Fed presents, let's say, the potential biggest risk more than geopolitics, Washington, etc.
I think so. You think about it's a midterm year coming up. Next year. I say it's not about red or blue. It's about green. Historically, markets like gridlock. Yes, the Republicans have both chambers of Congress right now, but the House is the smallest majority in 140 years. The last, I think it's 12 or 14 years, one or the other, but close enough for government work. We had a split Congress, the stock market was up. What tends to happen in a midterm year? Don't get mad at me, don't shoot the messenger, it's just facts. The party that obviously lost the U.S. election, presidential election, tends to gain seats in the House and the Senate. Very good chance that the Democrats probably take back the House. Republicans, maybe they kind of lose a seat or two, but still take on the Senate. That's a split Congress. Again, that historically is quite bullish. I think one of the big reasons a year ago right now, we had that huge ripper of a rally when President Trump won. No, it's not because President Trump won. It's usually the uncertainty of the election's out of the way. But the fact the House was way closer than anybody thought, that's that gridlock. That's why it's harder to get anything done. Sometimes that's a good thing. Because if you have a big blue wave, you start spending money all over here. You have a big red wave, you start spending money all over there. That's not always a positive thing. So when the midterms come up, everybody votes with whatever they're going to vote for. But if you're an investor, honestly probably want a split Congress. Because that's historically what tends to do well. Yes, the stock market has done better historically under Democratic presidents, but when Republicans control both chambers of Congress, it's actually done better for them than when Democrats. And listen, I don't like to ever invest in this. We say never invest in politics. I've seen so many people, I can't stand President Obama. What'd the market do? Went straight up for 8 years. I can't stand Trump 1.0. What'd it do? Great 4 years. I can't stand Biden. Well, first 2 years, not so great. Last 2 years, awesome. First 100 days under Trump, pretty terrible. Trump 2.0. How's it done lately? Yeah, so just really separate yourself from politics, focus on those fundamentals, and maybe root for kind of a divided government with some close races in the House and Senate for gridlock, so you can't get so much through. And anything you get through, both sides have to agree on, kind of work together, and maybe it actually benefits everybody, which is kind of the point of the whole thing.
Those are some wise words, Ryan. I really appreciate you taking the time today, and we'll do it again soon. No, this is an honor. Again, congrats on this new podcast. Congrats on all the success. This is an awesome, Matt. Thank you, Matt, for helping. I talk to Matt all the time on the computer in my basement. Yep. But this is an honor to get to come to New York, your awesome city, and see all this. I just did a thing with Sully at CNBC. We're going to dinner tonight, and you're coming later. And I look forward to this and look forward to reading your newsletter, Mark. I'm sure you're putting me in there, so I appreciate it. Thank you.
But thank you for having me. Appreciate it, Phil.